Hi everyone, I'm Aura Ogorian with ACap Advisors and Accountants, and welcome to another edition of the ACap Recap, where we go behind the blog and answer some of your most important questions. And today we're going to dive deep into AB 150. Now, there's a lot of information out there about what is AB 150 and who it impacts, including a video that I did not too long ago. But if you want to learn more about what AB 150 is, please check out our video and our blog post. Today, we're going to talk about actually how to calculate AB 150, which there seems to be very few videos out there or articles on how to actually calculate AB 150 and how it's going to impact you on your taxes. So stay tuned. We're going to dive right into it. But in the meantime, remember to subscribe, like, and share our channel. And if there's a topic that you want me to discuss or you want us to discuss, be sure to include it in the comment section below or send us a message and we'll be sure to cover it in a future video. Okay, so let's dive right into it. Let's assume we have Art Vandelay, who owns Vandelay Industries, and it's an S corporation. So in this case, Vandelay Industries we're going to do a couple scenarios. In this first scenario, Vandelay Industry has not decided to elect the PTE tax, which is a pass-through entity tax, and they've got sales of $502,000. And they've got officer compensation of $120,000. They've got some other expenses, and we'll see they've got a franchise tax that they paid from prior year of about $5,200. Once we add up all the expenses, we see their net income for federal tax purposes that's going to pass through onto their K1 on their personal taxes is about $259,846. When we calculate the California tax, we have to add back the California taxes that are paid for the prior year. So in this case, we add back the $51,76, which gives us a California net income of about $265,022. Now, what we're going to do is we're going to calculate what the California corporate tax is going to be, the California personal income tax, and also the federal income tax. Remember that as an S corporation, the corporation doesn't pay federal taxes. It's only passed through to the individual, and it's the individual that pays tax on the net profit of that S corporation. So let's see what happens first on the California corporate side. First, we're going to calculate what the franchise tax is on the net income of the California Corp. In this case, it's going to be $265,022, which we've taken right above here. And then we're going to multiply that by the 1.5%, which is the California franchise tax. Now, because in this scenario, the person, Art Vandelay, has chosen not to elect the pass-through entity tax, that is zero. So the total corporate tax for California is 3.975, or an effective tax rate of 1.5. Now let's go on to the personal federal return. Because Art Vandelay has other types of businesses and he's got other income, he's got taxable income of about, let's say, $709,000. This is the pass-through from Vandelay Industries, but also all of his other income that he's getting. Based on that, his total tax is, in this example, $199,000, which puts him in about the 28% tax bracket. On the California side, his taxable income is about $721,000, a little bit higher than the federal because California excludes certain types of write-offs. And his total tax for California purposes is about $62,000. Now, again, he is not elected to do the pass-through entity tax, so he doesn't get a credit for that. On his California effective tax, it comes out to about 8.6%. So his total federal and California taxes are $265,118. Now let's see what happens when he decides to elect for the pass-through entity tax. Still, his sales are going to be the same. His expenses are going to be the same. However, on the corporate 1120S, he's going to have this line item, pass-through entity tax, which is 24,647, and I'll show you later how we calculated that. That reduces his net income for federal tax purposes from 259 down to 235. Then when we calculate the California net income, we have to add back that adjustment. We'll see here, we add back that California adjustment, which is the prior year franchise tax and the pass-through entity tax. That means his California net income is the same whether or not he does the pass-through entity tax or without the pass-through entity tax. But where the real benefit comes in is when he does his personal taxes on the corporate and his personal income taxes. So when we do the California corporate tax, we take the total net income for California purposes, multiply that by the 1.5%, which is the same had he chosen not to do it. Then he has to pay an additional 9.3% tax, which is at 24,647. That brings his total tax liability to 28,622, which is a lot higher than had he not chosen to do the pass-through entity tax. Now, when I enter this into our tax software, it calculated a penalty. I would recommend you override that penalty because even though the tax software assumes there's a penalty because the tax wasn't paid on time, the reality is that this tax was actually owed by the tax filing deadline. So there isn't a penalty for underpayment because the actual tax is 24,647 is not due until the tax filing deadline. So the reality is there should not be a penalty calculated. Now our tax software calculated that. There might be other softwares out there that don't calculate that, but if it does, I would recommend you override it and not calculate that penalty. Now, if we move over to the federal personal side, we'll see that the taxable income on the federal side is now a lot less because the pass-through entity, the net income for the federal level is now significantly less because they paid that tax on there. And as a result, the federal income tax that's owed, if ARC decides to do the pass-through entity election, is now over $10,000 less. Moving on to the California side, this is actually where the real benefit comes in as well. Actually, you get a benefit on the federal side, which is the purpose of the tax, but you get a credit on the California side. So the California side, the taxable income, again, is lower, and the total tax ends up being lower compared to had he not taken it. We'll see, as we see in this column. But he gets a reduction of the pass-through entity tax credit that he paid. So that $26,000 that ARC paid through the corporation now gets a credit on his personal taxes, reducing his total tax due from $59,000 down to $32,000. And if we see how that compares to the total taxes he's paid, we'll see that his total tax is now $251 versus the $265. So a big, almost $14,000 difference benefit from electing to do the pass-through entity tax. Now, I did this exercise because I wanted to show you how to calculate the pass-through entity tax, but it doesn't mean that everyone is going to benefit, especially since there's so many other nuances and so many other permutations that could go into actually calculating the tax. I'd highly recommend you have someone do your taxes, make sure that the calculation is correct, especially when you factor in all the different credits and all the different nuances of the federal tax and the personal tax. But again, the purpose of this exercise is just to see how to calculate the tax, where the numbers go, how it flows through on the personal and the California tax, and then whether or not there's a benefit for making that election. Hopefully this was beneficial for you. If you have any questions, please feel free to reach out to us and stay tuned for another edition of the ACap Recap.